How's it going, guys? Friday. So I'm pretty sure that if you're watching this video, you should have already known about what's happening with the inflation that's going on. We are at 7.5% inflation year over year, and of course, people are a little bit worried, which is why when we first saw the inflation report drop, you saw Nasdaq down, you saw your S&P down. Basically, all the indices were down for about like 1 to 2% or so. Then when the market actually opened, a lot of them basically did a huge recovery into the open. Of course, due to the fact that people were either buying the dip, people probably read the report, like myself, understanding that there's actually nothing too crazy about the entire report, and people were a little bit more risk on than risk off. But anyway, let's cover some news today, and we get into the Wall Street Journal before we actually see more of what is going on in the market. All right, let's go over Wall Street Journal. Okay, so stocks finish sharply lower, bond yields rise after inflation data. Let's see why they actually went down. About like 3 a.m. or so, I realized that the stocks basically all went down. For price action wise, in the pre-market, I was down about 3% or so when options weren't actually being considered for any sort of price movement before the market opened. And when the market opened, about say like an hour and a half into the market open, I was up about 8% or so because most of my bullish my bullish options were all up. Of course, my bearish options were all down. Seeing how we actually had such a huge increase into the market. But of course, right now, looking at the market right now, I think a lot of them are going to be going down. And when the market do open, we are probably going to be seeing some sort of downturn. People are a little bit more wary. Like I said before, if you're unaware, on the 16th of February, we'll be getting the January FOMC meeting minutes. And then on the 10th of March, we'll be getting the February CPI data. And then 16th of March, we'll then get the FOMC meeting for J Powell. Most likely, he'll be talking about the rate hikes. And yeah, I think I did read a news on Bloomberg about how a Goldman Sachs analyst is actually looking at 7 rate hikes instead of 5 rate hikes. I'm not sure how what the analyst is thinking. But whatever the case may be, I did post on my Instagram. If you're not following me on Instagram, follow me right here, at Ong Hak Hauser. I post there pretty much daily. And if you are interested on my story, you can basically see what I am seeing and what I'm actually talking about most of the time at real time. So instead of me actually posting a video every single day, yeah. But anyway, let's see. The most followed new data showing inflation had accelerated to 7.5 here. Okay. Let's see. Okay, the data and comments injected fresh uncertainty into the market has shown more sign of stabilizing. Okay, so shown more signs of stabilizing. That's kind of what I was talking about as well yesterday. If you want to, right now, if you can go and look at my Instagram, I actually posted my short-term review on what actually happened. If you want to listen to the whole entire thing, you can go to my YouTube channel. Yesterday, I posted for the inflation data news segment. I'll be talking about the entire thing in like a 30-minute video anyway. Entering Thursday session, S&P 500, Ryzen, 7 of the previous 9 trading days. That's pretty good. Okay. Money manager bracing for more volatility. I'm pretty sure that the VIX index actually went up quite a number yesterday, from what I understand. The VIX, the VIX is at almost 24, so that's pretty bad. I guess the trend is worrisome for equity markets, as it could mean a more aggressive Fed policy response, which is what we're talking about. And of course, I think the current concern right now is that if we were to see a 50 basis point increment, because right now, if you're actually pricing in 5 rate hikes, for example, which 5 rate hikes is already pretty bad as it is, and if we actually price in 5 rate hikes, and having 25 basis point at every single turn of the way, we're still looking at 1.25% by end of 2022. And personally speaking, I don't think that 1.25 is going to crash the market, because the market has pretty much priced in the fact that we're going to hit 1.25%, I would assume. But of course, the issue is that if Jerome Powell is so worried about the inflation, where he would be hawkish about it, so, which is why it's very important for us to see the CPI for next month as well. So the next month's CPI would be absolutely important because that would be happening 5 days before the FOMC meeting. And if we have a very, very hot report over there, aka 0.6%, 0.8% month over month, the FOMC meeting would most likely be talking about the inflation, how they can lower the inflation, how they can bring inflation down as low as possible for the following months, and what can they do to the policy in order to do so, because that's when we actually completely finish tapering. Okay, so when that actually happens and we have to lower the inflation, the Feds can, like what we're really afraid of, where what they're actually saying here, a more aggressive Fed policy response, is that if Jerome Powell says that he wants to increase it by 50 basis points, aka 0.5% for March, he can probably do it again in June, he can do it again in July, and if he actually do 4 out of 5 rate hikes with a 50 basis point increment, we'll be looking at 2.25% by end of 2022, which would be detrimental to the economy. Of course, you do have to also take into consideration, which this is also a very, very big point, especially I talk about Jerome Powell and such. It's not Jerome Powell's job to save the stocks market, nor is it to save our portfolio. That's not in his best interest. Like I said before, they only have 3 main things that they have to worry about, which is max employment, reasonable inflation, and also maintaining a strong and progressive interest rates. And currently, they would like to say that the max employment is settled, but I have my own differing views. But the other 2 parts of things are the issue. We're not having low inflation, nor are we having proper interest rates, which is why they're trying to at least take one down out of the way. And yeah, because of that, I feel that it'll be very, very dangerous for us to really see a hawkish Jerome Powell to see what will he basically be doing for the market. Okay, we caution that the market could remain choppy for the coming months until either inflation stabilizes or the market is comfortable that the Fed is doing enough but not too much, like what I said before. Because if right now I feel that the market has basically kind of priced in the fact that we are going to get 1.25% by end of 2022. I think that the market is pretty comfortable with that. They are all right with that as it is. They're not super duper worried about the interest rates going up by 1%, something crazy like that. They are not worried. They think that that's completely fine. 5 rate hikes, sure, but what they are worried is the 50 basis point and the 75 basis point increment. That's where the fear actually comes in. That's where the uncertainty comes in, and because of that, it's very, very fair for the market to kind of panic a little bit if they don't know what's going to be coming up in the next few months. So yeah, okay. But they didn't really tell us the reason why it was dropping. I was actually quite confused because when everything started rotating down, I was actually quite confused because there wasn't any sort of particular catalyst to actually show why we're having this weird trend down, other than the fact that traders are already getting out of markets, but that happens every single day anyway. So I didn't really expect that to be that big of an issue where the entire market would be trending downwards into closer where we're running into the close. But yeah, I think that suddenly seeing the entire market kind of just U-turning back down was very, very weird. I was expecting the market to be a little bit hotter. Everyone should be a little bit more optimistic, especially with having such a report. Like I said before, the report didn't really show us things that are super duper bearish. If anything, it's actually quite bullish because we can actually see some sort of an inflection point where I might actually be more positive on the outlook for February's CPI, because I think that the February CPI, we don't really have things that we are that afraid of, other than the fact that fuel oil might still be trending upwards. There is a possibility that for used cars and trucks, the scenario that actually given in the video, which is like, for example, we don't know why is there no huge jump in prices for all the used cars and trucks. Is it due to the fact that the demand and supply are so nicely dealt with that there is no increase in price, or is it because there are not enough deliveries for them to actually have a proper factor to even say that, you know, we're increasing price, because the supply chains are actually getting delayed. Cars are not getting out in time, and because of that, they cannot sell enough cars, and because of that, the lack of information is unable for them to actually clock into the CPI. That's the scenario that I'm very, very afraid of. So yeah, I think that's kind of like the worry that I have for in terms of the CPI side of things. But if that is not really the concern that we have as a market, then yeah, I think that it's mostly bullish from here on out. So yeah, that's kind of like my take on it. But okay, anyway, I think we already went through this yesterday. But something interesting here that I really wanted to try it out, which is calculate your own inflation rate. I thought it was very, very cool. So, like, for example, if you are an average urban consumer, so you know, you're just a city boy, city girl, whatever, housing prices are the one that's going up. So you should be getting an annual inflation of 7.5%. But if, for example, if you are just eating out, okay, you are traveling, you don't really care about housing as much, your inflation rate is actually 7.6%, and it's actually quite interesting. So, for example, for an older person with high medical expenses, your annual inflation is actually 5.9%. Surprisingly, it's going to be lower because as compared to an average urban consumer, you can see that you are probably spending lesser, or no, okay, you're spending more on transport and housing, I guess. But then for older person with higher medical expenses, you're paying more for Medicare, and apparently, Medicare probably do not have that high of an inflation, so maybe that's why. Parent with children under 5 years at 5.4%. So if you're actually interested, you can just head over to the Wall Street Journal to try this out. I thought it was quite interesting because I'm thinking, you know, like food at home, I would like to put it around here. Alcoholic beverage, I'll put it at 0 because I don't buy alcohol as much. Apparel, I don't buy apparel. Housing, on the other hand, I would like to kind of like put it somewhere here, I guess, because the refinancing that for my house would be coming in about a year or so that I might want to look into. Medicare, I would like to put it somewhere here since I have been going to the clinic quite often. Transportation wise, I'll put slightly higher because of the car. Recreation, I don't really do anything for recreation, so that's fine. Education and communication, I think that this would be somewhere higher up in here, just because I do spend a lot on like software and such. I think that's kind of what communication is for. Food away from home. Okay, you know what? I'm going to put this higher because I spend a lot on food. Okay, clearly you can tell from my size, but I spend a lot on food, and yeah, I think because of that, I can actually put that high. So yeah, over here you can see the annual inflation rate for my spending is about 8.4%, which is horrible. So yeah, we gotta earn more money. Jeez. Okay. But anyway, I think that's all about this article because I actually went through this yesterday with you guys. Okay, this is something new. Okay, surging inflation heightens Fed and debate over how fast to raise rates. Something that I also talked about earlier, touched on. The question facing Federal Reserve official ahead of the policy meeting next month is no longer whether they will raise rates, but rather by how much. Like I said, we are almost certain that we'll be getting the rate hike on the 16th of March when Jerome Powell come out and say, all right, we are done with tapering. Now we'll begin with the increase of interest rates, and we'll be doing it by XX basis point. Okay, so now this XX basis point, we're thinking, would it be a 25 basis point or would it be a 50 basis points? That's where we're actually coming from. Of course, there are also those bears who are thinking that Jerome Powell might actually come out and just rock pull the market by saying that, yeah, we'll be doing a 1% increase immediately. Which again, like I said, not exactly impossible because of course, if we were to get such a huge pain in a short period of time, of course the market in the short term will be going down. But this would really curb inflation to a T, and I think that this would actually help the economy a lot more. But of course, the market wouldn't want to hear that. The market hearing 100 basis point increment would decimate the market. The market would not like that whatsoever. And yeah, because of that, I do not think Jerome Powell will be doing that either, because I think Jerome Powell to a certain extent, he kind of want to rug pull the market as well. So I would assume that he would most likely be hovering between the 25 basis point and 50 basis point, and we'll see how it goes from there. So another strong inflation report released, blah, blah, blah. Okay, we already know this. The debate still has weeks to play out. Could lead official to begin lifting interest rates from near zero next month, with a larger half percentage point increase rather than a standard quarter percent point move. So yeah, like what you said before. And of course, like I said, what did you say? Okay, yeah, because this debate has still has weeks to play out, and like I said before, I think that right now, from what we actually get from the data that we do have right now, with a 7.5% year-over-year data, I would easily say that 25% and 50% can go either way. But if we do get the CPI data on the 10th of March, we should be reflecting for the February data. If we do get something that is like overly positive, such as a 0.2% or a 0.3% month over month, there is a good chance that this FOMC can really change out completely, and we will almost be certain to be getting a 25 basis point increment instead. However, if we do get 0.8% or something ridiculous, like I said before, 50 basis point wouldn't exactly be something that I would say it's not going to happen, because if anything, I'll lean more towards the 50 basis point if we do get such a high report, because that would bring our year-over-year data to over 8%, and I can easily see why Jerome Powell would want to be more hawkish in order to curb inflation as it goes. So yeah. Let's see. Yeah, so the Fed hasn't raised rate by 0.5% since year 2000, aka post financial crisis. They have yet to do so. They don't even dare to touch the fact that we are going. If it is since 2000, I'm assuming this was during the dot-com bubble, but even the dot-com bubble was in 2003. So they actually have never done a 0.5% point increase in a super duper long time, and yeah, which is why I think that the chances of it happening isn't very, very high. But of course, with constant bad inflation reports, I think that it's only possible for us to actually explore that side of things. All right, the Fed official in the months ahead are watching for signs that the month-over-month pace of price increase will slow. Yeah, that's kind of what I was thinking about as well. Thursday report brought a little comfort on this front. Elevated inflation has been primarily driven by the brisk demand for goods, shipping bottleneck, and shortage of intermediate goods such as semiconductors. But prices in January firmed up in the service sector. Okay. The Fed is deeply behind the curve on inflation. There's no other story at this point. Yeah, I mean, that is true. When Jerome Powell talked about transitory inflation and then flip-flop to say that transitory is going to be retired, I'm certain that a lot of people were actually hating on him a lot, I guess. We don't want to be disruptive or surprising markets. I would like to do this in the smoothest way possible, and we so far have achieved that. He said, adding that he would change his view if the data went against us here. So yeah, like I said, I think that Jerome Powell is a very understanding person. I think that he's not someone who is unreasonable as well. For him to be disrupting on the market, of course, I don't think he's the kind of person who want to go full hawkish and then tighten the market by its neck, get a short recession, and then afterwards we get a good rally afterwards, and then just so-called save the market in the short term. I don't think he's in that mood to do so. I do instead feel that there is a good chance that Jerome Powell would want to just kind of like let the market know that what we're actually going through, and 25 basis point is really the go-to move I would assume Jerome Powell to be taking in the FOMC meeting. Of course, this does take into consideration that the February data that's going to be coming on the 10th of March is not going to be something ridiculous. So yeah. Okay, yeah, basically the same thing. Surprisingly, very, very little news because I think everyone just talking about the CPI. I think that's how important the CPI is at the moment. Where CPI comes out, for the next 2 days, people are just going to be talking about CPI, and that's how crazy it is. But yeah, okay. Anyway, there wasn't huge earnings yesterday. Only Twitter and Twilio, which did surprisingly well. But yeah, I think that's about it. Today there won't be any earnings, so it's good for me, and then I can spend some time with my sister. But yeah, I think that's all I have for today. Oh, hold on, it's Friday, so I have to actually give you guys my weekly trades. You'll be surprised how little weekly trades I have because I literally only made like three trades for this week. Okay, I bought more Ford puts. I bought more Ford puts. I bought more Ford puts. I bought more Peloton puts. I bought more Peloton puts. I bought more Peloton puts. That's about all I have for this week. I'm actually quite bearish on this week because I was expecting CPI to miss, which it did. Of course, the price action that we actually had yesterday wasn't something that I expected. But of course, right now it's starting to really reflect how it should actually be going towards. So I'm very, very happy with that. I did lock in on a few calls where I just wanted to just realize the profits as it was going to be expiring in another 2 weeks or so. But yeah, locked in a few profits, and yeah, that's all I have actually. But thank you guys for watching, and I'll see you guys next week. Well, no, actually, I do have a video for tomorrow on a Saturday. That's my weekly video. By the way, yeah, thank you guys for watching, and I'll see you guys on Monday.